Though, it ended with a bang. Now remember, when Wave 2 gets underway, most people are still quite convinced that that old bear market may still be alive. It brought us into the low. There was a good deal of skepticism on this advance. And notice that right off the 1937 high, the market started down in a crashing mode. And people said, here we go again. It's 1929, all over. We're going to new lows. There was a great deal to worry about from a psychological standpoint. And of course, when the market came down and broke the prior low, there was more worry. What about the fundamental situation? Remember, Wave 2 usually gives you a severe test of the same style of worry that the actual bottom had. What was happening in 1942 as the stock market was making its low? Well, the United States was involved in World War II. And in fact, at that particular time, there was a good deal of thought that the Allies were on their way to losing the war. Now, again, the stage was set for a good deal of fear about the very question of survival of that market. For a different reason this time, but an equal amount of worry and concern that the market was going to survive. This created a base pattern from which this powerful third wave began. It started in 1942, lasted 24 years, all the way into a peak in 1966. As is classic, psychology changed right along with it, very slowly at first. People don't get excited at the beginning, they merely get less worried. But that is on the way toward a very good feeling, which is finally achieved at the high. First thing that happened, as fundamentals begin to support the Wave 3 movement, was that the war started to improve for the Allies. In this period, the Allies won the war. We got into the late 1940s, and the post-war depression that so many economists were predicting didn't happen. You had more good news, or at least less bad news. From there, the market began to go a little higher into the early 50s. Prosperity began to return. Global peace was pretty much at hand. Prosperity got better and better as the 50s went along, and people went from one-car families to two-car garages. We got into the early 60s, finally into the mid-60s, and that's when the euphoria really began to show. In fact, if you remember back to that time, we decided that things were going so well for the United States that we were the economic and military rulers of the world, essentially, that we could afford both guns and butter and create something called the Great Society. You don't see that kind of legislation at a major bottom. You see it at a major top, a celebration of how wonderful things are and how we can do anything we want to do. We can afford to do anything we want to do, a classic signal of a major top. As we got into the mid-60s, the euphoria was evident in all kinds of ways, but certainly on Wall Street, it was very difficult to find an analyst anywhere who was very bearish on the outlook for stock prices. There is at least one who was. His name was Charles J. Collins. He was the man who, back in 1938, brought R.N. Elliott to Wall Street in the first place. He was the man that Elliott wrote to and said, I have a discovery, I'd like you to look at it. He looked at it, he was convinced it was valuable, and he set Elliott up in an office. He was also an excellent practitioner of the wave principle himself. Hamilton Bolton, after Elliott's death, had carried on with the analysis of the stock market, and he was publishing a supplement to his publication, The Bank Credit Analyst. At that time, he had to be out of the country, and he asked Charles Collins if he would mind writing the supplement that year. It was 1966. He spoke to him in January. The market peaked in February. Collins wrote his report in March. It was published in April, right here. And Collins said very clearly, we are in for a bear market. The sequence, which began in 1942, is now ended. It has subdivided into 5 waves according to Elliott's rules, and that means we're going to start the biggest bear market since back here in 1937 to 1942. He said, I think it's going to last 10 years and probably carry into the 500s. As I said, he was one of the very few bears on Wall Street at the time. In some ways, Mr. Collins was actually a bit optimistic. The bear market did carry into the 500s, but in terms of the price pattern and the inflation-adjusted value for the Dow Industrial Average, it actually lasted 16 long years into 1982. Well, 1974 marked the price low at 572.20. 1982 marked the end of a sideways corrective pattern under the wave principle, and from that point we launched wave 5. First, let's figure out whether wave 4 follows the typical idea of a fourth wave under Elliott. Remember, we described it as a surprising disappointment. There were plenty of surprising disappointments throughout this period. There was more inflation than people expected. We were involved in a war that most people didn't like. It was unpopular. Eventually, we lost the war, or at least withdrew, with many people believing we had lost it. There was a president in office who had to resign in disgrace from a scandal. Shortly thereafter, inflation picked up again to even higher levels. We had another president who was widely considered one of the most inept in the history of the United States. And year after year during this period, people were saying to themselves, how can we be doing this? We're the United States of America. This is ridiculous. They were disappointed year after year, and their stock prices were eroding and reflecting that problem. You see, they had finally come to the realization in about 1964 that we truly were in a bull market that was not going to stop. And they were very disappointed when they discovered that that conclusion was wrong, that we were in a bear market. The disappointment finally ended with the recession of 1981. We just had a new president in office. People felt that his economic policies would change things, and immediately we got a recession. That was another disappointment, but it was the last one of the sequence. From that point forward, starting in August of 1982, the stock market blasted off. Its initial liftoff was so strong it was the fastest rate of change on the S&P 500 in 40 years. To be precise, the strongest since right here. The last time an upward movement of this degree began. Well, the 80s have provided a wonderful bull market. The percentage advance from 1974 to the 1987 high was the same as we saw from 1932 to 1937. It just took several years longer than that period did. Now, the biggest question that we face today is the 1980s bull market typical of a fifth wave? Now, we've already discussed the ways that we would just make that decision. One is technical, one is fundamental. The first question, is the 1980s bull market as technically strong as the bull market of the 1950s? Well, I'll tell you, the answer is it ain't even close. From 1942 to 1966, you could almost throw a dart at the Wall Street Journal and pick a stock which ultimately was going to go up. Let me show you the difference in the advanced decline figures from Roman numeral wave 3, which is our 24-year wave 3 advance, and in Roman numeral wave 5. That's a picture of the cumulative advanced decline line, and it shows the incredible power in the market in terms of breadth from the 1942 liftoff. This is a plot of the number of stocks which on a daily basis are going up minus those that are going down. The plurality was terrific as wave 3 took off. That plurality remained incredibly powerful as we moved into the late 1950s and began to wane when we finally got into the fifth wave of the third wave in the early 60s. Now, I must point out that the construction of this chart is not the best that could be done. There are more stocks traded on the New York Stock Exchange every year, and this is merely a difference. It really should be done on a percentage basis. But if anything, it merely points out the incredible weakness of the 1980s bull market. We have more stocks, and yet if you subtract the downs from the ups every single day, you find that this is the kind of performance we have seen since the 1974 low. I'd also like to point out another little thing. On the previous chart, we saw wave 4 from 1966 to 1982. It looked pretty mild, really, a sideways consolidation, essentially. This is what happened to breadth during that period. An absolute collapse into 1974, a rebound, and nearly a double bottom in 1982. Elliott was one of the few to recognize that a sideways pattern is a correction, and the internal statistics, such as the advanced decline figures, bear that out. Well, from 1982, this is the net progress of the advanced decline line. In other words, it has been very difficult in the 1980s to pick a stock that was going to go up with the bull market. It wasn't a given that if you chose any old stock that it would follow prices up. This is classic fifth wave behavior. What about the fundamental background of wave 5? I think we would all agree that the fundamentals or the economics surrounding the market in the 1980s has improved relative to the 1970s. The inflation rate has receded. Interest rates are down from 16% closer to 6, 7, 8%, depending on the instrument you're watching. We're not involved in a war anymore. So people can look around and say, okay, things are generally better now than they were in the 70s, but remember, the key is not to compare the fundamentals of the 80s with the 70s, but the fundamentals of the 80s with those of wave 3, most of which occurred in the 1950s and going into the early 1960s. Can we really say that the fundamental background today is better than it was during that period? We currently have a 7% interest rate. Back then, rates were between 2 and 4% throughout that entire bull market period. We've had, as people have pointed out many times, a trade deficit that is setting records every month. It's a problem. It doesn't determine where the market's going, but it's a fundamental event that's in the background. It's not as healthy as what we experienced in the 1950s and early 60s. What about the federal debt? Back in that prior time during wave 3, it really wasn't much of a problem. Of course, as we entered wave 4, and still as we are in wave 5, the federal debt sets records year after year. What about the global debt situation? How many countries were in trouble with their debt back in the 50s and early 60s? Very few relative to today in the 1980s. So if you objectively compare the two, you'll see that the 1980s fundamental background is weaker than that of the 1950s and early 60s. Why is this important? Because it's going to get down to the final point of why a fifth wave brings you the largest correction since the entire sequence began. Its engine, for the most part, is psychology. People are saying things are improving. Okay, maybe they're not as good as they were once before, but I'm going to put my little blinders on and I'm not going to worry about it. We're going to try to recreate the glory of those wave 3 days, but even if we can't quite achieve it, we're going to try, we're going to get there. This is based on hope. This is not based on the actual reality of the background fundamentals. That's why prices get so extremely overvalued when a fifth wave occurs on a major trend basis. And of course, if you've looked at any of the charts of prices relative to earnings, prices relative to dividends, or prices relative to book value in August of 1987, you saw that you had to go back to 1929 to find a configuration indicating an equal overvaluation. All right, we discussed 3 rules of the wave principle. Now I'm going to discuss 3 guidelines. What's the difference between a rule and a guideline? Very simply, a rule is something that describes market behavior in such a way that there are no exceptions. A guideline gives you a suggestion of what is most likely to happen, but does not guarantee that a formation or pattern will work out in a specific way. Nevertheless, these guidelines are so important and so valuable, they really are the key to good performance in the market. They're the key to the track record that the Elliott wave theorist has generated over the past 10 years. They're the key to how well Hamilton Bolton did from the 1950s into the 1960s, and so on. So these are the next most important things to learn about the wave principle if you want to apply it yourself. The first one I'd like to bring to your attention is called the guideline of equality. After observing hundreds of charts of stock prices, Elliott came to another observation. He said, when the third wave is the longest, it is usually the case that waves 1 and 5 are approximately equal in terms of price movement and the amount of time it takes to unfold. I'm going to refer to the Dow Industrial Average chart just to give you an example of what he meant. All of the charts we'll be looking at during these 2 days are going to reflect these guidelines, but it's sometimes easier to see these things visually. Look at the subdivisions of Wave 3 itself, from 1942 to 1966. You'll notice that Wave 1, which is marked with a circle, and Wave 5, which is the movement between Circle 4 and 5, are much more equivalent in terms of time length and percentage price gain than this longer movement for Circle Wave 3, which occurs between 2 and 3. There is a substantial difference between the two, between Wave 3 and, on the other hand, Waves 1 and 5, which tend toward equality. All right, the next guideline I consider the most important. It's called alternation. It says very simply that if Wave 2 takes a simple, sharp movement against the trend, then Wave 4 will take a complex sideways shape against the trend. Going back to these pictures of corrective patterns, if one of the two corrections, let's say Wave 2, moves sharply against the trend, such as this pattern does, or even as this pattern does, the next correction, or Wave 4, is likely to look more sideways. And very often, Wave 4 will make a new high within the corrective pattern. Of course, the opposite is true as well. If Wave 2 takes the sideways shape, then Wave 4 will be the sharper movement against the trend and contain no new high. Is there an example on this Dow Industrial Average chart? Well, let's look at Wave 2 from 1937 to 1942. You notice that it is moving sharply against the trend. It was a 50% wipeout in a matter of 5 years. No new high occurs within this corrective pattern. Therefore, once Wave 3 was over, you could have assumed Wave 4 would take a sideways shape. In fact, A.J. Frost, in writing in the Bank Credit Analyst Supplement of 1970, said exactly that. And sure enough, that's just what we got. A complex sideways movement. In January of 1973, the Dow Industrial Average actually hit a new all-time high as part of the correction. Ironically, that was just before the smash of 73.4, and the sideways period ended finally out there in 1982. That is a classic representation of the idea of alternation. The third guideline I want to bring to your attention answers the question, how far will a correction carry? Stated alternately, at what level will a correction end? And this particular guideline has been responsible for some of the best Elliott wave calls made by any of the people following this approach. And I want you to understand it because you can use it over and over and